Understanding the basics of funds transfer pricing, FTP. Funds transfer pricing, FTP, is a critical concept in the financial industry, but many people are not familiar with it. In this video, we will discuss the basics of FTP and why it is important. What is funds transfer pricing, FTP? FTP is an internal pricing framework used by banks and financial institutions to allocate and assign costs, revenues, and profits to different business units or product lines. It is a way to measure the profitability and performance of various activities within an organization. Why is FTP important? FTP plays a vital role in decision-making and performance evaluation at financial institutions. It helps determine the true cost of funds and the profitability of different products and services. By understanding how FTP works, banks can make more informed decisions about pricing, risk management, and resource allocation. How does FTP work? FTP takes into account two main components: the cost of funds and the earning assets. The cost of funds is the interest rate a bank pays for its sources of funding, such as deposits or borrowings. The earning assets are the assets that generate income, such as loans or investments. To calculate FTP, the cost of funds is allocated to each earning asset based on its risk profile and duration. This ensures that each business unit or product line bears its fair share of the funding costs. The allocated cost of funds is then subtracted from the income generated by the earning assets to determine the net interest income or profitability. Key factors influencing FTP. Several factors influence the FTP rate. These include market interest rates, credit risk, liquidity risk, and other costs, such as operational expenses. Changes in any of these factors can impact the FTP rate and the profitability of different activities within a financial institution. Benefits of FTP implementation. Implementing an effective FTP system offers several benefits to financial institutions. Firstly, it provides greater transparency and understanding of the true cost of funds and profitability. This knowledge helps organizations make data-driven decisions and optimize their performance. Secondly, FTP helps align incentives and rewards within a company. By allocating costs and profits correctly, employees and business units can be appropriately incentivized for their contributions. This encourages a culture of accountability and performance-driven behavior. Lastly, FTP helps financial institutions manage risk. By linking funding costs to risk profiles, banks can assess the impact of different risks on their profitability and take appropriate measures to mitigate them. Conclusion. Funds transfer pricing, FTP, is a crucial tool that enables financial institutions to allocate costs, measure profitability, and make informed decisions. By understanding the basics of FTP, banks can optimize their performance, manage risk effectively, and enhance their overall profitability. Want to learn more? Claire Trifle on LinkedIn.